North American markets dragged down again today. The TSX down several hundred points. Let's go to Jay Bala, CEO and Senior Portfolio Manager, AIP Asset Management, to talk about what's going on. Jay, thanks for joining us today.
Hey, no problem. Thanks for having me on.
We were talking about inflation numbers today, and we know that the numbers are trending down. I wanted to ask you, first of all, whether you think the Bank of Canada was right in signaling the rate might not move.
Yeah, no, I think right now they're sort of thinking about it on the short end of things, but on the longer term, if you look at it over the next few years, it's very clear which way interest rates are going to be moving. They're going to go steadily downwards, and I don't think they want to rush it, right? Whether they cut in a few months or a few quarters from now, either way, those interest rates are going downwards.
We started the year out with the tariff threats by Donald Trump, and a lot of what has unwound was from Liberation Day. What would you say is the biggest threat to the Canadian economy at this point?
Yeah, look, I think our Prime Minister has mentioned this a few times in that this is a functional paradigm shift. The idea of free trade is over, and I think we need to all start retooling for, the next phase of this, which is, we're going to go into a world where, tariffs are back on the table. Free trade with the United States in particular is pretty much done. And so we need to think about, how do you retool the Canadian economy? And I think, they've put forward a plan. And look, at the end of the day, whether you agree with the plan or not, what you do know for sure is that it's going to be lots of spending. It's going to be backed by a lot of borrowing. And in order to keep this timetable going, they're going to have to keep interest rates very low for a very long time.
Does that, perhaps, that spending promised by the budget offset weakness that we are beginning to see?
It's not going to offset it in the near term because, the thing with building, any large-scale project is, if you think about, what happens in the first 6 months, well, in the first 6 months, it's just a lot of the planning, you're drawing up blueprints, you're coming up with ideas. Most of the spending isn't going to happen in, until like year 2, year 3, year 4, where you're actually doing the building. And so in the short term, it's not going to help much. And that's why I kind of always repeat the idea that, investors need to sort of start looking at their portfolio from a fixed income perspective, because the key risk here is, that we go into a low interest rate environment and we stay there for many, many years to come. And so, those investors that need yield, need to find ways of getting yield that, may not be, and it may not be something that people are thinking about, just with the recent market sell-off. I think there is a lot of advisors out there, probably a lot of investors who've said, look, I've had a great run in the equity markets. Let me rebalance. Let me lock in yields while I still can. Yeah,
we're having a look at the bond yields, and I'll get to that in a moment. But let's talk about the TSX, dragged down today, several hundred points, down 308 right now, but just pushed back over that 30,000 mark. What's weighing on investors in your mind?
No, I think what's weighing on them is at the end of the day, they've had a huge run. And I think, we're coming towards the end of the year, and I think a lot of people are saying, look, I'm clearly overexposed to equities. Let me cut back. Let me, roll back into some kind of yield product that I can get where I can actually get yield for the next 3-4 years while, interest rates continue to stay low, right?
Okay, so are you beginning to see money moving around? You mentioned fixed income is a good idea right now. Is that what you're seeing?
That's what I'm seeing. We're seeing a lot of opportunities in convertible debt. We're seeing a lot of opportunities where, you can lock in rates for the next 3 or 4 years. And at least you'll have some kind of steady, sort of returns or income out of that sleeve for the next few years. Because, if you're in a short-term fixed income instrument right now, there is no way that you're going to meet your requirements, right? If you think about the average person who might have or medium risk portfolio that has a 60-40 portfolio, for the next 2 or 3 years, even if you're locked in today with government bonds, you're looking at 2.5-3%, which is pretty much where inflation's going to be at, right? So it's becoming quite risky for people, and I think they're just rebalancing out.
Okay, so if people are looking at bonds, it's one thing. Are there other sectors you like right now?
In terms of fixed income, obviously, look, anything that tilts towards these strategic projects is helpful, right? any kind of fixed income that comes out of the energy space is going to be helpful. Anything that comes out of resources is going to be helpful. Anything that comes out of energy or like electricity generation is going to be helpful. And I think those are those are the places where you're going to kind of see good value for now. But in general, we just really do think that fixed income is a space that investors, if they're not paying attention to it today, should really be focusing on, because once these yields are gone, you won't be seeing them for the next 3 to 5 years.
Got it. All right, Jay Bala, CEO, Senior Portfolio Manager, AIP Asset Management. Jay, thanks for your time.